It is December 22nd, 2025. While you're planning your holiday break, checking your Robinhood account, and wondering why your portfolio has been moving sideways for the last 3 weeks, something critical just happened across the Atlantic. Something that the mainstream media in the US is completely ignoring, but which could be the loose thread that unravels the entire sweater of the 2026 global economy. The European Central Bank has just hit the pause button. Again. For the 4th time in a row, they've frozen the deposit rate at 2%. But that's not the headline. The headline is what they didn't say. Imagine being in the cockpit of a Boeing 747. You're flying through a hurricane. You ask the co-pilot, "Hey, are we going to climb above the storm or dive below it?" And the co-pilot looks at you, shrugs, and says, "Honestly, it's too early to speculate." That is exactly what Madis Muller, a key member of the ECB Governing Council, just told the world. He admitted they have no idea where the economy is going next. Why does this matter to you, sitting in Chicago, London, or Toronto? Because the last time central bankers were this uncertain, we got the 2008 crash. The time before that? The stagflation of the 1970s. When the second largest economy on Earth admits it is flying blind, that volatility doesn't stay in Europe. It crosses the ocean. It hits the dollar index. It hits the earnings of Apple, Tesla, and McDonald's. It hits your 401k. The engine of Europe is stalling, and the pilots are refusing to touch the controls. Today, we are going to peel back the layers of this diplomatic silence to reveal the terrifying economic reality underneath. We're going to look at why this wait-and-see approach might be the biggest trap for US investors going into 2026. Let's set the scene. It's late 2025. We've spent the last few years battling the post-COVID inflation monster. We've seen rates skyrocket, we've seen tech stocks bleed, and we've seen a recovery that feels fragile. In Europe, the deposit rate is sitting at 2%. In a vacuum, 2% sounds healthy. It sounds normal. But in economics, context is everything. Yesterday, the ECB held that rate steady. Today, Madis Muller, who represents Estonia, a country that understands the pain of inflation better than almost anyone, came out on Estonian radio and dropped a bombshell of ambiguity. He said, and I quote, "If you ask what will happen in 6 months, it's honestly too early to speculate." He then laid out 2 scenarios. Scenario A, the euro area economy tanks, inflation dies, and they cut rates. Scenario B, the opposite happens, and they might have to hike again or hold longer. This is what we call data dependency in polite circles. In reality, it's paralysis. Here is the problem. Central banking operates with a lag. When the Fed or the ECB moves a lever today, it doesn't hit the real economy for 12 to 18 months. It's like steering a supertanker. You have to turn the wheel miles before you see the iceberg. By saying we don't know and let's wait to see developments, Muller is essentially saying they aren't looking at the horizon anymore. They are staring at the waves right in front of the boat. If they wait until the data proves Europe is in a recession, it is already too late. The recession is already killing earnings. If they wait until inflation proves it's reigniting, it's too late. Prices have already destroyed consumer purchasing power. For the American investor, this 2% level in Europe is a critical threshold. It represents the line between a soft landing and a deflationary spiral. And right now, the ECB is standing on that line, closing their eyes, and hoping the wind doesn't blow. Now, I can hear you asking, I live in Texas. I trade the S&P 500. Why do I care what an Estonian banker thinks? Here is the mechanism. It's all about the spread. The global financial system is basically a giant game of seeking the highest yield. Money is liquid, it flows to where it is treated best. Right now, we have a delicate balance between the US Federal Reserve and the ECB. If the ECB is paralyzed at 2%, but the US economy shows any sign of heating up or cooling down, the gap between the dollar and the euro widens. Let's play out Muller's scenario, the one where the euro economy doesn't do well. If Europe starts to crumble, Germany's manufacturing slows down, French luxury goods stop selling, the ECB will eventually be forced to panic cut rates. They will drop from 2% to 1.5%, maybe 1%. Meanwhile, if the US stays steady, the dollar rips higher. Great, you say. Strong dollar. Wrong. For the multinational companies that make up the bulk of the S&P 500, your Apples, your Microsofts, your Coca-Colas, a super strong dollar is a earnings killer. They make their money in euros, but they report their earnings in dollars. When the euro collapses because the ECB fell asleep at the wheel, those US corporate profits vanish overnight due to currency conversion. We saw this in 2022. We saw this in 2015. When the currency spread gets out of whack, US stocks take a beating. But there is a darker side to this. It's the exporting of deflation. If Europe enters a recession because the ECB refused to cut rates early enough, which is exactly what Muller's hesitation suggests might happen, European demand dries up. Europe is one of the biggest customers for American and Chinese goods. If they stop buying, global supply chains back up. Inventory gluts form. Prices crash. This sounds like good news for inflation, but it's bad news for debt. In a deflationary environment, the real value of your mortgage, your car loan, and the US national debt effectively goes up. The ECB sitting on its hands at 2% isn't a sign of stability. It's a sign that the global liquidity pump is clogged. And when the pump is clogged, the pressure builds up until something bursts. Usually, that something is the stock market. To understand the danger of Muller's comments, we have to look at history. Muller said, there are no grounds to hastily change interest rates up and down. This is the classic wait-and-see trap. Let's rewind to the 1970s. The U.S. Federal Reserve, led by Arthur Burns, kept toggling rates. They would hike to kill inflation, see the economy slow down, get scared, and cut rates too early. Then inflation would roar back, and they'd have to hike again. It created a decade of stop-go policy that destroyed the stock market. In real terms, the stock market went nowhere for over 10 years. By keeping the rate at 2% and refusing to commit to a direction, the ECB is risking a stop-go failure. If they are wrong, and inflation is actually bubbling under the surface, holding at 2% is like fighting a forest fire with a garden hose. By the time they realize they need to hike, inflation will be at 5% again, and they will have to crush the economy to fix it. On the flip side, if they are wrong and the economy is weaker than they think, holding at 2% is strangling the patient. We saw this in 2008. In early 2008, the ECB actually raised rates while the US was already melting down, because they were obsessed with inflation. They missed the forest for the trees. They didn't see the systemic collapse coming. Muller's comment that it's possible to imagine scenarios in both directions is an admission that their models are broken. They are flying without radar. And when central banks fly without radar, smart money runs for the exits. This is why you are seeing gold hover at all-time highs. This is why Bitcoin is reacting violently to macro news. The market senses that the pilots have lost control of the plane. We cannot talk about European interest rates without talking about the elephant in the room, energy. It is December 2025. Winter is settling in over Berlin and Paris. The ECB's hesitation is directly linked to the volatility of energy markets. Muller knows that if energy prices spike again, that 2% rate is useless. But if energy prices collapse, 2% is too high. Why does this matter to the American viewer? Because the US is now the world's LNG superpower. If the ECB keeps rates high and crushes European industry, the demand for US energy exports collapses. That hits the energy sector of the S&P 500, Exxon, Chevron, the midstream pipeline companies. These have been the dividend darlings of the last few years. If Europe goes into a deep recession because of this monetary paralysis, the floor falls out from under oil and gas prices. Furthermore, look at the geopolitical angle. A weak European economy, hamstrung by a hesitant central bank, is a weak geopolitical ally. It means less funding for defense, more political instability, and more populism. Markets hate uncertainty. And Muller just served up a giant platter of uncertainty. He explicitly said, if the euro area economy doesn't do as well, maybe there's reason to reduce rates further. Maybe. That word should send shivers down your spine. A central banker saying maybe is like a surgeon saying oops. They are watching the same lagging indicators we are: unemployment claims, GDP prints, PMI data. But by the time those numbers turn red, the damage is done. The bond market is already screaming a warning. The yield curve has been doing strange things. Investors are buying long-term bonds because they expect growth to fail. They are betting against the ECB's optimism. They are betting that Muller is wrong, and that the wait-and-see approach will turn into a panic-and-cut reality very soon. So, where do we go from here? Muller says it's too early to speculate. But we aren't paid to be diplomats. We are paid to protect capital. So let's speculate. The bull case: in this scenario, Muller's hesitation is actually genius. The 2% rate is the Goldilocks zone. The European economy cools down just enough to kill the last remnants of inflation, but not enough to cause mass unemployment. In 6 months, the ECB sees stable data and slowly cuts to 1.5%. The euro stabilizes against the dollar. US multinationals report strong earnings from Europe. The S&P 500 rallies to new highs, driven by a synchronized global recovery. Likelihood? I give this a 20% chance. It requires everything to go perfectly right. The bear case: this is the scenario you need to hedge against. The ECB holds at 2% too long. We are already seeing cracks in European manufacturing. This hold turns those cracks into canyons. By Q1 2026, Germany enters a hard recession. The ECB panics and cuts rates aggressively in spring 2026. The euro crashes relative to the dollar. The DXY spikes to 110 or 115. US corporate earnings recession hits. Wall Street sells off. Simultaneously, because the global consumer is tapped out, we see a deflationary wave. Real estate prices in overheated markets come under pressure as liquidity dries up. The stagflation nightmare: there is a third option. The ECB holds at 2%. The economy stagnates, but due to supply chain shocks or energy wars, inflation stays sticky at 3 to 4%. This is the worst of both worlds. They can't cut rates because of inflation, but they can hike because of no growth. Capital flees Europe. It floods into the US, creating an asset bubble here that eventually bursts. So, Madis Muller doesn't know what's going to happen. But you need a plan. Here is your playbook for the indecision of 2026. 1. Watch the dollar index. This is your canary in the coal mine. If the ECB remains frozen and the US economy stays resilient, the dollar goes up. A rising dollar is historically bad for stocks and commodities. If you see the DXY breaking out, it might be time to trim riskier assets. 2. Quality over speculation. In a world where central banks are unsure, you do not want to own unprofitable tech stocks that need low interest rates to survive. You want companies with fortresses on their balance sheets. Companies that generate cash today, not in 2030. Think healthcare, defense, and consumer staples. 3. The Treasury yield. If the ECB is wrong and a recession hits, global capital will flee to safety. That usually means US Treasury bonds. We could see yields drop as price goes up. Holding some short-term government bonds isn't a bad place to park cash while we wait for the fog to clear. 4. Be wary of European exposure. Check your ETFs. How much exposure do you have to the Eurozone banking sector? If Muller is signaling uncertainty, the banks are the first to feel the pain of a policy error. It might be time to look at more US-centric or emerging market opportunities that are decoupled from the ECB's mess. Madis Muller and the ECB have told us everything we need to know by saying nothing at all. They have told us that the era of forward guidance, where central banks held our hands and told us exactly what would happen, is over. We are back to the Wild West of macroeconomics. They are waiting for the data. But as investors, we cannot afford to wait. We have to anticipate. The pause at 2% is not a peace treaty. It is a ceasefire. And ceasefires have a nasty habit of breaking down when you least expect it. Whether it's a deflationary crash or an inflationary resurgence, the volatility is coming. The silence coming out of Frankfurt is deafening. Do not mistake this stillness for safety. It is the calm before the storm. Watch your currency exposure. Watch the energy markets. And most importantly, do not assume that the people flying the plane know where the landing strip is. I'll be watching the charts, so you don't have to. If you found value in this deep dive, destroy that like button to help the algorithm fight the recession, and subscribe so you don't miss the update when the ECB finally blinks. I'm Boss. This is Boss Economics World. And I'll see you in the markets.